So do we have a questions from a client boss that asking how can I legally pay my kids through my business and get a tax benefit?
Okay, there's different ways to do this, and there's lots of ways to screw it up. So if you pay anybody from your business, then that's going to be a deduction to the business. So whether it's you or whether it's your kids, whether it's a stranger, anybody you're paying a payroll check to is going to be a deduction to the business. So that's number one. The question then becomes, how do we supercharge that? And the answer is that if minor children, so under 18, are paid directly by their parents, and directly, it could mean a couple things, then they are exempt from Social Security tax, they are exempt from Medicare tax, they're exempt from federal unemployment tax, and in most cases, they are exempt from state unemployment tax. Depends on the state, but most of them follow the feds on that one. And then if you pay anybody less than whatever the standard deduction is for that year, then they're not going to pay any income tax either. And sometimes there's differences between the federal and the state on that. So sometimes people end up paying a little bit on state income tax. So the real answer is you needs to be directly employing, which is going to mean either a Schedule C, a Schedule F, or a partnership, because those carry self-employment tax considerations. Let's just say you have a partnership, because that's typically the way we want to set it up. You have a partnership between you and your spouse, and you employ your kids. Now, I said they have to be under 18. Can they be five? The answer is no. They got to be at least eight. And eight is not a law anywhere, but it's emerged from court history of these things being challenged as far as eight is old enough to justifiably perform some economic activity. There's people who talk about it, like, I put my kids on my business card, so I'm going to pay them as a model. Okay. If you paid a kid a random modeling fee for 2 hours worth of work a year, how much is that going to be? It's not going to be a lot. So just wait till they're eight, and then you're more in the clear. So if you have kids employed by a partnership that's directly owned by a husband and wife, then that's going to be under this exemption umbrella. It could be a Schedule C also, but partnership is better. So the kid has to be doing something. You can't just wave a magic wand, right? And so, like, when they're younger, a lot of times when we talk with clients, we'll talk about, okay, they can do janitorial stuff, they can start to do admin stuff, depends on the capability of the kid also. So like I have a now 11-year-old, she was 10 a month ago, but my 11-year-old is does office admin stuff. So she opens mail, she scans, she shreds, and she does like office admin type of stuff. And I looked up based on my local market and based on those particular job duties, what does that actually pay in my particular place? And so I gave her an hourly wage based on that. And so you can you can expand that as the child's capabilities expand. So when they're teenagers, a lot of times I'll have the kids be the client's social media directors or social media managers. So you can they can do all your social media posting, they can do research on your competitors or client research or customer survey kind of stuff. And they're actually generally better at it than you are. So it's actually worth paying them to do it. And it's a high value skill and commands a lot in the marketplace. So it's a high dollar hourly wage that gets associated with that. And then once you're in that zone, you can supercharge it even more if you start to incorporate the IRAs or other kinds of retirement plans. IRAs are the most common. Let's say the standard deduction this year for 2025, if for anybody, for a single person, is $15,000. So anybody who has taxable income of $15,000, or not taxable, but adjusted gross income of $15,000 or less, they subtract 15,000 from that. Now you're at zero, so there's nothing to tax. Okay, so anybody who's paid 15 grand or less during the year is going to pay zero income tax. And if they're under this arrangement, they're also going to pay zero Social Security tax, zero Medicare tax, zero unemployment tax. So it's tax free, and it's still a deduction to the company that paid them. So that's how we get all this to flow through to the benefit of the parents who are owning this company. And then if we add an IRA into it, that becomes a Schedule One adjustment. This is a traditional IRA. So if you pay your kid $20,000, and yes, they have to do stuff in order to justify the $20,000. If you pay your kid $20,000 and contribute 7,000 to an IRA, now it's going to be 20 minus 7, which is 13, which is less than 15, still tax free, still put 7 grand into the IRA, which is going to grow for 50 years, and it's going to be worth an enormous amount of money. It is, as we're recording this, it's 2025. In 2027, there is a new version of the retirement savings credit that is coming out. I forget, I think they're just calling it savers credit or something like that. And what it is for low income people, right now, if you are low income and you contribute to a retirement plan, you get a non-refundable tax credit, meaning that if you owe taxes, you'll owe a little bit less because of contributing to your retirement plan. In 2027, that is changing to the government is going to put money into your retirement account directly, up to $1,000. So in in 27 and forward, in 27 and forward, if you are low income, which if you make 20,000, you're going to be, and you contribute to a retirement plan like an IRA, then the government is going to kick in $1,000 extra into that IRA. And it doesn't become taxable income. It just gets in there. And then when you take the money out in retirement, then it becomes taxable. But that's 50 years away. I did the math on this. If your kids are the right ages, where you do it each year from age 8 to 17, 1,000 extra over that period of time, given average market assumptions and all this kind of stuff, you're talking about an extra $600,000 in your kid's retirement plan just from doing that. So it is yes, it's a tax deduction to the parents if you set it up correctly, and it sets your kid up for massive success later on. And I don't know why I can't talk anymore, but really powerful strategy. Now, the main objection I get to this from parents is I don't want to pay my kid 10 grand or 15 grand or whatever the number is. I don't want to pay them that because then I'm out the money. You have to keep in mind, it's like you're not out the money because you're spending money anyways, right? You're spending money on kids' clothes, on camps, on video game, whatever it is, right? And so now going forward, you just spend their money because you're still the parent, you're still the custodian of these accounts. Whatever money you were spending, there's now you're spending their money. And you will be amazed at how economically conscientious a kid can get if it's their money that's being spent. I want to buy rollerblades. I want to buy this. I want to buy that. It's, okay, here's how much you have in your account, and then we're going to spend it. It's like, whoa, wait a minute. let's just let's back up, and you might find yourself being a little bit more cost efficient that way. Now, another thing that people always bring up with the kids is what about private school and that kind of stuff. Private school is not deductible, but if you pay your kid and the kid's paying for private school, then that works because you're paying the kid. That mechanism actually solves a lot of problems, and it's definitely worth doing. And you get to teach your kids all about making money, saving money, investing money, spending money, all these lessons that are really valuable as they're growing up and going into adulthood. Because I don't know about you guys, but I learned like nothing about money when I was a kid. And so I got two sisters. We all got into financial trouble in our 20s because I think that's just how it worked out. Had I had a little entrepreneurial education prior to that, I think I might have done better, but everybody's going to be different. So that's how you do it, though. You set up a structure so that you can pay them. You got to pay them a reasonable amount based on what it is that they're actually doing, and then you can supercharge it potentially with the retirement strategies.
All right. Thank you, Neil, for that.